The pitch has always been the same. A 40-foot sailboat on a turquoise anchorage. The smell of salt water in the morning, a coffee mug in the cockpit, no alarm, no commute, no landlord. The yachting industry has spent decades selling that image, and it has worked. In 2024, the global yacht charter market cleared $8.39 billion. New catamaran orders stretched production backlogs to 18 months across the major European builders. Brokerage listings for used blue water sailboats in the 35 to 50-foot range commanded median asking prices above $400,000 in the United States. The dream is not the problem. The problem is the arithmetic behind it, which the industry prefers to discuss only in brochure language. The industry's own consensus, drawn from surveys of active yacht owners and published by YACHT and Yacht Trading in 2024 and 2025, puts annual operating costs at 10 to 15% of a vessel's market value. On a $300,000 sailboat, a modest realistic entry point for a blue water capable monohull in the current market, that figure runs between $30,000 and $45,000 per year before a single mortgage payment. Depreciation makes it worse. A new yacht loses 10 to 20% of its value in the first 12 months on the water. By year 5, cumulative depreciation reaches 40 to 50%. That same $300,000 boat is worth between $150,000 and $180,000, and you will have paid the equivalent of its original purchase price in operating costs to get there. Standard yacht ownership is engineered against the buyer. The broker who sells the vessel collects a commission and disappears. The charter management company that promises offset income takes 30 to 40% of gross revenue before the owner sees a dollar. The marina that holds the boat charges between $1,500 and $50,000 per year in slip fees depending on location, and raises that figure by 12 to 15% annually in corporate-owned facilities. Every party in the transaction extracts from the same asset. 3 financial structures have produced documented positive returns for sailors who built them deliberately before the first line was cast off. They are not myths or loopholes, and access to none of them requires a 9-figure net worth. Each one dismantles a different mechanism of the standard ownership trap, and each one has verified numbers behind it. Before the 3 archetypes, a set of verified benchmarks defines what the standard model costs, drawn from industry sources published between 2024 and 2026. Annual operating costs for a $300,000 vessel, $30,000 to $45,000 per year. New yacht, first-year depreciation, 10 to 20%. Cumulative 5-year depreciation on a new vessel, 40 to 50%, per YACHT 2024 market analysis. The United States sailboat market median sold price as of October 2025 is $330,500, according to David Walters' Yacht's Monthly Market Report. Average time on market for a United States sailboat listing as of October 2025 is 172 days, up 15% year over year, with buyers negotiating an average discount of 7.26% from the asking price. The national median rent for a 1-bedroom apartment in the United States as of April 2026 is $1,510 per month, per Apartment Advisor. In coastal American cities, San Francisco, Miami, Seattle, Boston, that figure runs from $2,100 to $3,400 per month. These benchmarks are not worst-case projections. They are the industry's own consensus figures, and they form the baseline that the 3 structures below were specifically designed to beat. The first structure is the Guaranteed Income Charter Program. A retired engineer in the Pacific Northwest, 62 years old, an experienced offshore sailor with no interest in managing a boat charter business himself, purchased a new 45-foot sailing catamaran in the spring of 2024. He did not park it at a marina and begin writing checks. He placed the vessel into a guaranteed income charter management agreement with Sunsail, one of the world's largest charter operators, with active bases across the British Virgin Islands, the Mediterranean coast of Croatia, Grenada, Thailand, and more than 15 other sailing destinations. The structure of the program is contractual, specific, and publicly documented on Sunsail's ownership website as of February 2026. Sunsail manages the vessel for 5 sailing seasons in the Caribbean or 6 seasons in the Mediterranean and exotics. During that period, the company covers all operating costs, annual dockage, hull and liability insurance, routine maintenance, and cleaning between charters at 0 additional cost to the owner. In exchange, the owner receives a guaranteed monthly payment equivalent to 8% of the yacht's purchase price each year, regardless of whether the boat actually charters that week or sits idle. On a $400,000 catamaran, that monthly payment works out to $2,667, enough to cover a standard marine mortgage on the vessel. Over 5.5 years, the guaranteed income totals $176,000. That is 44% of the original purchase price returned to the owner in cash, while the management company absorbed every operating expense the standard ownership model would have charged him. The owner also retains up to 12 weeks of sailing time per year, usable on his own vessel or on equivalent sister ships at any Sunsail or Moorings base worldwide, a sailing vacation budget that would cost a non-owner between $35,000 and $55,000 annually at market charter rates. At the end of the program, the vessel sells through the company's brokerage operation. Catamarans maintained under managed charter programs hold 50 to 65% of their original purchase price at resale based on Catamaran Guru's 2025 program analysis. This places the residual value of a $400,000 boat between $200,000 and $260,000. Combined recovery across income and resale is between $376,000 and $436,000 on a $400,000 purchase. The mechanism works because the vessel was never purchased as a leisure asset. It was a contracted income producing instrument that happened to also be a sailing holiday. The ledger does not lie. The second structure is the Liveaboard housing arbitrage. A merchant marine officer working the Gulf Coast spent 11 years paying rent on a 2-bedroom apartment near the port of New Orleans. In 2022, he purchased a 1988 Cape Dory 40 outright, paid in full, no financing, for $68,000 from an estate sale in Beaufort, North Carolina. He moved aboard and set the anchor in a protected cove 12 nautical miles from the port. He reduced his monthly housing expenditure from $2,200 to approximately $1,800 in total monthly costs covering food, insurance, haul-outs, engine maintenance, fuel, and every other living expense combined. The $400 monthly differential is not the full picture. The national median 1-bedroom apartment rent of $1,510 per month represents a floor, the cheapest category. A 2-bedroom apartment in a coastal American city where a working mariner actually earns a living runs between $2,100 and $3,400 per month. Against those numbers, the documented budget Liveaboard cost range of $1,500 to $2,500 per month, validated across multiple 2025 and 2026 Liveaboard cost analyses, including Salty. And Windy and As You Stay represents a genuine structural saving, not a theoretical one. Over 7 years, at a $200 monthly differential, the accumulated housing cost savings total $16,800. At a $1,200 monthly differential, realistic against a coastal 2-bedroom, the figure reaches $100,800. The vessel purchased for $68,000 is also not gone. The Cape Dory 40 is a boat built with hand-laid solid fiberglass, a full iron keel, and hull scantlings drawn from the offshore racing standards of the 1970s. Production ended in 1992, and fewer than 300 hull examples were completed. Used Cape Dory 40s in maintained condition currently list on brokerage platforms between $70,000 and $110,000, above the $68,000 purchase price paid from the estate sale. The sailor bought a depreciating asset on paper. In practice, he bought a maintained value asset that replaced rent, eliminated property tax, and preserved capital, while the standard ownership model was busy extracting $45,000 per year from a marina slip 2 miles down the coast. The arrangement is only as honest as the math allows. In this case, the math held. The third structure is the tax-structured charter business. On July 4, 2025, the United States federal government signed the One Big Beautiful Bill Act into law. The legislation restored 100% bonus depreciation for qualifying property. Placed in service after January 19, 2025, a provision that had been phasing out since 2022 and that reached 40% in the year before the bill passed. For yacht owners who structure ownership through a legitimate commercial entity, the provision changes the first-year financial position of a yacht purchase in a way the standard ownership model cannot replicate. A construction company operator based in Fort Lauderdale, with high annual income, an established corporate structure, and experience as an offshore sailor, purchased a $500,000 sailing yacht in August 2025 through a limited liability company registered in Florida. He placed the vessel into an active bareboat charter operation in the British Virgin Islands through a professional charter management company with 25 years of regional operating history. Under Section 179 of the Internal Revenue Code, combined with the restored bonus depreciation provision, he deducted the full $500,000 purchase price as a business expense in the tax year the vessel entered charter service. In the 37% federal income tax bracket, that deduction produced a federal tax reduction of $185,000 in year 1. The charter operation generates revenue. Mid-size bareboat charter operations in the British Virgin Islands produce between $250,000 and $300,000 in annual gross income, according to Virgin Islands Yacht Brokers' 2025 market analysis. After the charter management company's standard commission, 30 to 40% of gross, the owner's net charter income sits between $150,000 and $180,000 per year. 3 requirements govern this structure without exception, and none of them are negotiable. The vessel must be used more than 50% of its operating days for documented commercial purposes, recorded in contemporaneous logs that the IRS can audit. The charter operation must function as a genuine commercial enterprise, with commercial hull insurance, a professionally licensed crew, active marketing, profit and loss statements, and evidence of intent to grow the business. Personal use of the vessel exceeding 14 days per year or exceeding 10% of the days it was offered for charter risks IRS reclassification as a second home, which eliminates the deductions entirely. This structure requires a maritime tax attorney, a CPA who has structured charter operations before, and a charter management partner with a track record of documentation compliance. The reward for that discipline is a first-year tax position that no standard financial instrument available at a brokerage desk can produce from a $500,000 investment. The pattern is not accidental. 3 structures, 3 different entry points into the same underlying logic. None of them required the buyer to be smarter than the industry. The guaranteed income charter owner paid nothing in operating costs for 5.5 years and collected 8% of his purchase price annually while sailing the Caribbean each winter. The Liveaboard arbitrage sailor eliminated rent as a line item, acquired an asset that held its value above purchase price, and accumulated 6 figures in housing cost savings over 7 years at anchor. And the charter business operator turned the industry's own depreciation mechanism, the same curve the marine industry has used for decades to explain why boats are financial sinkholes, into a first-year deduction that wiped out a year of federal income tax liability. Every sailor who ran these numbers made the same discovery: the industry's financial engineering is not inevitable. It is the default outcome for people who accept the brochure instead of reading the contract. Which structure fits your situation? Drop it below.